What's up, Facebook Live? We are doing our first live broadcast Q&A. I'm Jason Balin. Next to me on the next screen, even though he's one office over, is my partner, Chris Haddon. Super excited to be here today. Obviously, so much stuff's changing on Facebook. As you know, if you run a business page on Facebook, the Facebook Live section's never been all that user-friendly, and now it is. And we've got this new content series starting. So if you're a business owner, if you're a real estate investor, if you just are interested in any of those things, we're here to help you. So a few quick things before we dive into this is this. So what I'm going to do is I am going to try to figure out how to post a link. And this link, if you click on the link, you can actually be on this live feed with us and ask any questions that you have. Any other questions that you have, feel free to comment on this feed. If you just comment below and you have a good question, if you have a fake question, we're probably not going to show it. But if you have a good question related to real estate, a good question related to business, we are happy to share it and answer your question. Again, 11 a.m. every Tuesday, we will be here with you. Today's topic is money options for your deals, for your real estate deals, the different types of money options available. Now, if you have any question related to that, feel free to chime in. Or if you just have any question related to business or real estate investing, please chime in on that as well. We're here to help. It's an open mic for the next few minutes or the next half hour or so. What are your thoughts, Chris, on that? You like that setup?
Yeah, definitely ready to roll. We're going to cover some good material about the financing options. Something I was thinking about that because we do discuss that fairly frequently on our web show, in our meetup group. And there's a good reason for that. And something I was thinking about is the fact that out of the different financing options, they're constantly evolving. It's not just learn it and you got it and it's there. With the markets and, both like financial markets and real estate markets, it makes these financing options change. Not like day to day, constantly like craziness, but they do evolve as the markets are changing and moving around. So it makes sense to touch base on this fairly frequently, because it's important to have the best financing options that you can.
Yeah, absolutely. And like we were talking about, feel free to comment on this feed, on this thread, and we'll answer any questions you have related to financing or business in general. And if I can figure out how to post or copy this link, maybe somebody that's watching, if you could copy this link, that would be great into the comments section. That would be cool, and then you could jump on as well. Okay, cool. So let's dive in. So obviously, the first way to fund a real estate transaction, if you have the means, is cash, your own money, or your IRA. Cash is great if you have it. Not everybody has enough cash to fund every transaction they're involved in, but if you have it, it's great. But a little hidden secret related to IRA or a retirement account is huge, because so many people might not have liquid cash, but they've been saving, and they've been stocking money away in their 401k or retirement plan or IRA. And there's actually options related to that money that you could access to buy a deal. Chris, what's your thoughts about that?
Sorry, I missed that thing. I was checking out what was going on Facebook.
IRA stuff. You want to talk a little bit about IRA investing?
Yeah. IRA investing is definitely, for sure, a niche, like a small part of what you have going on in real estate. It can be more, but for people like full-time operators and even people who are doing side deals, the IRA doesn't come into play all that often. It's a little cumbersome. You can use IRA money. Your IRA can own a property, and some people sort of specialize in that, but it can definitely be cumbersome. So I would say that the first important part is to do your homework, and don't. There's a thing with the IRS called self-dealing. A lot of people make a mistake and do that and commingle their personal funds with their IRA simply because they don't know. They don't know the rules. They're not experienced with it. So definitely do your homework and that's a good rule of thumb when it comes to IRA investing is keep your IRA money not connected to your personal funds or that of your immediate family. And if you just get that one thing, of course, there's a lot of other like niche little rules and stuff that you could spend the time learning. But if you just remember that one, that'll help you out a lot.
Sure. And I mean, like we were talking about earlier, I mean, a big benefit about IRAs in general is, you're accumulating money inside your IRA. right? You're accumulating it because you save some money in your IRA over a long period of time. A lot of people don't have stockpiles of cash just sitting around, but you invest a few $1,000s a year in an IRA, and it grows, and it grows quickly. So, it's one thing to have the option with it. And keep in mind, with your IRA, you can lend money to somebody, to an investor. You could buy a rental property. You could buy a flip. There's even creative ways with your IRA that we can talk about in the future related to leveraging up with a hard money lender. So your contribution comes from your IRA. Maybe you put down 20% in your IRA because you don't have enough to buy the whole property, and then the hard money lender does the rest, puts up the rest. So all good stuff. So again, as we go through everything, any questions that you have, we have a decent amount of viewers right now following. If you have any comments, feel free to comment below. Happy to answer any questions that you have. All right, so we do have a question related to Ian Walsh, okay, or Ian Horowitz. Thanks, buddy. IRA investing is awesome. It sure is. Okay, got some other questions coming in real quick. Let's see. Torino, what we got? Hide current comment. All right, hold on one sec. I got to figure out how to add your comment up here.
That's a good question there from Torino. I think we should touch base on that one.
I got to figure out how to pop it up. Is it showing up on your screen?
I see it on my screen, yes.
All right, why don't you answer that question while I try to figure out a way to get this on the screen?
Okay. Yeah, so Torino asked, how much money do you need to start flipping rehab properties, to start buying, fixing up, and reselling real estate deals? So it's definitely important to get your cash in line before going into a property, because there are cash requirements. There's going to be some sort of down payment and closing costs. In all likelihood, you're going to have monthly payments to whatever your financing source may be. Even if you finance a construction job, you could easily go over budget, which is very, very common. And plenty of investors do find themselves in a cash pinch, and you don't want to be in a cash pinch. So a couple things on that. The average cash to close for one of our deals is about 20% of what we're lending. And okay, so let's use the example of, say you're buying a property for $150,000, you're putting $50,000 into it, so $200 total job costs. You're going to be bringing about $40,000 to the table to cover closing costs and what have you, and you're going to want to have some additional cash. I mean, I would say, to be honest, you're going to want to have, call it $50,000 available to do a $200,000 deal. And listen, I know a lot of the TV shows out there and people selling information products are promoting you don't need cash to do real estate deals, and you don't necessarily need your own cash. This could come from investor capital, what have you, but cash is required in some form or another. And that could mean teaming up with a partner. That could mean doing one deal, not buying 2 or 3 at once, which a lot of newer investors make the mistake of doing. Do one deal at a time until you have several under your belt. That's something we definitely preach. So yeah, I mean, in terms of giving you a quick answer to that question, I would say 20% or more. It doesn't necessarily have to go into the deal. It could just be in your bank account, but plan to have about that 20% of what the total job is going to cost.
Yeah, I think that's a good point, especially since, there's always overruns. There's always so much stuff, unknowns that could go wrong. And real estate in general, real estate is always thought of as an asset, and it really is. But if it's properly mismanaged, it'll turn into a liability very quickly if you take on too much debt and you don't have money to cover your payments or whatever the case is. So it's super important. So Trino, I appreciate it. All right, it looks like we actually have a guest we're going to bring on right now. His name is Ian. He's got a question that he wants to answer, that he wants to ask for us to answer. And again, anyone who has a question that they want us to answer, you don't necessarily have to comment. If you comment, we'll be happy to answer it. But if you just go to this link right there, you must be on Google Chrome browser. That is one thing that this Facebook Live software makes us. So, all right, let's try to patch Ian in real quick.
Ian coming live from Miami Beach.
Ian, what's up, buddy? Welcome to the show.
Hey, how you guys doing?
Not bad. How are you?
Good. I'm in Miami at a conference at IMN Single Family Residential Conference. got our project manager here, Ryan Tucker, and oddly enough, it's been a common theme at the conference about, what's the best financing options for long-term rentals. Obviously we've all done the institution route, just knowing what our business is. There's a lot of national lenders now offering non-recourse. Interest rates maybe are 1% higher, 1.5% higher, just trying to figure out what a good, we're talking from going from 5% to maybe 6.5%, but not having the PG aspect, guarantee. Is it worth doing that type of financing?
So let me ask you another key question. With those financing and those lenders in place, how long are they, number one, amortizing those loans for, and number two, how long are they, they setting it up for a call or a balloon payment? Are they going out 60 months like standard local banks, or are they going out longer than that?
Yeah, a lot of them are. I don't know what my computer's doing. Yeah, a lot of them are standard like institution type loans with a 5 or 7 year call. They have 30-year options, but then the interest rates, you're starting tracking up into the 7.5%, 8%. 30-year debt might be worth it. You don't have to think about it, but kind of makes me nervous. Just you never know where the market's going, and I guess got to make a decision and go with it. So it's kind of how do you grow your company and have the right debt options, or kind of try a few things and see where it goes.
Yeah, I mean, I think it's really threshold and risk tolerance that everyone, individually what you have. I mean, personally, a lot of the assets that we have in a lot of our rental portfolio, the goal is to get them paid off in about a 10-year time frame. And a lot of the local banks that we have in place want 5-year calls on them. And that being said, just because you have a 5-year call doesn't mean that it's necessarily balloon, sure, have to be paid over that period after that period of time, but they do have the right to call it at that time. And that does make me a little bit nervous, especially since, the environment that we're in right now seems that interest rates may be growing a little bit. The housing is kind of towards the top. There is some unknown factors on that. I would personally be willing to pay a slightly higher interest rate in order to, obviously the personal guarantee is huge if you don't have to. I would never take on debt for something that I wouldn't honestly be comfortable personal guaranteeing. There's times that, Chris and I have been offered a lot of money for leveraging up like some of our portfolios or lending portfolios. And because they had a personal guarantee and it was a ton of money that they wanted to lend us, it just didn't work great for us personally. But, a lot of our rental portfolios, I was more comfortable doing it. But if I didn't have to for a little bit higher, be happy to do that. And I'd be happy to pay a little bit more for a little bit safer debt. Personally, like on my primary residence, a lot of people say, hey, well, the average loan stays out for 5 years or 7 years. I like the 30-year fixed option if we're relating this to a primary residence, just because it was a quarter or half a point higher. The payment wasn't that much. And you know what? It was just more of a peace of mind.
Yep, sounds good. I think we're on the same page in the end. Doing the PG is fine. Just sometimes you got to limit your risk. And and the other question is, are the properties still cash flowing based on a 6.5 interest rate instead of a 5.5 interest rate? And right. Well, and I guess the good thing is a lot of those lenders have, almost like stop limits that, if your debt service coverage ratio isn't there, they're not going to let you leverage that high at that interest rate. So that's kind of where all that comes into play. And oddly enough, we were talking to one of the lenders last night. Interest rates for them have actually gone down, even with everything in the market. It's gone down by almost, they were saying 1.5%. I'm actually getting ready to run out up to the conference to go meet with them and discuss with it. But, they've gone from 8% down into the mid, under 8%. It was high 7s, and now they're telling us they can get us done at like mid 5s. So check it out, see what it is. Maybe it's a good option, and go from there.
Yeah. There's a lot of institutions and a lot of banks and investors in this space right now. I talking about money in deals. Obviously, if you're a national lender and you're funding localized construction projects, I truly believe that's a bad idea. But if you're funding national stabilized rental properties at a low LTV, it seems like a pretty safe investment for some of these national lenders. Especially if you have a property that, as long as they can properly value the properties, and as soon as you get into some center cities, as all of a sudden you're getting $1,500 a month rents on a property that might only be worth 40, 50 grand. So as a bank, I guess you just got to be smart.
Right. All right, guys. Well, thank you for answering my question.
Yeah, no, thanks for checking in. Looking forward to hearing some more about what's going on down that neck of the woods.
I wish I was outside and could have showed you all the beautiful views.
Yeah, I'm sure there are.
All right, see you.
Until next time, thanks.
Keep stopping by.
Cool. Well, that's good. Glad Ian checked in. All right, so let's get to the next level of private investors. You want to chime in a little bit on private investors and why they're a good funding source?
Yeah, for sure. Private investor capital is one of the things that I handle here at Hard Money Bankers. So I do have 10 years plus of experience raising private capital, dealing with investor relations, everything else. Private capital can definitely be a very, very useful part of your real estate business, but there are some things to be aware of. First, I'm not an attorney or an accountant. There are legal issues and accounting issues, but to a lesser extent, associated with handling private investor capital. So please talk to an attorney before you go to raise capital from any individual investors. But I can definitely comment on some of the process and good things to know when managing investor capital. So when we talk about the different kinds of financing options, we often compare what it's going to cost you to what kind of job are you creating for yourself by taking on this kind of capital. So private investors can be a bit less expensive than a hard money lender, yet typically more expensive than bank or institutional money. So that's something good to know. You're probably going to be paying anywhere from, call it 8% to 14%, something like that. It can be more flexible than a hard money lender because in essence, you, when approaching capital investors, are making guidelines. You are setting up how it's going to go, what it's going to cost when you're making payments, everything else. Is it monthly payments? Is it profit share? All different kinds of ways to do it. But the important part is that you're making the rules on that, and you're going to want to find investors that fit into your setup, not the other way around, right? Also, in addition to that, Jason and I are big proponents of the DISC personality profile, DISC. If you aren't familiar with that, maybe we can post a link or just Google it real quick. It's a very popular thing, not only in business, but just, in life in general. It's a very, very good thing to know. And I'm not going to go too much in depth on this, but because it could be, a presentation unto itself, which it has been. I've been using the DISC personality profile and raising capital since, 2007 or 8 when we first started. And without going too in depth on that, you're going to want to focus on the D and the S, not too much on the I and the C. At a later date, I can go address that and say exactly why. But yeah, in general, private investor capital is a great source, a very, very useful thing in real estate investing. Just, get your process down, know exactly what you're offering, and definitely cover all bases when it comes to legal stuff.
Cool. Good tips. Good tips on private investors. Cool. All right. So the next funding source for your deals, if you're just chiming in, we were talking cash and IRA, and we talked about some private investors. If you want to ask any question related to business or real estate or money in general, feel free to comment in this live Facebook thread, or you can go to this link that I'm going to post right now on Facebook and jump in there as well. Next funding source, hard money lenders, probably our favorite, and I wonder why. Maybe because we are hard money lenders. But in all reality, I truly believe that if you're not currently using a hard money lender, you really need to look into that. It doesn't matter where you are. They're going to serve a purpose. We have borrowers that are bankable, that have a lot of cash, that have lines of credit, and they have a lot of private investors, and they still utilize us as a hard money lender because you never know what happens. You get a property that all of a sudden got ratified and you're a little bit short on funds and you need the additional money. And, we fund loans in a day. That's just what happens. Or 2 days, it closes quickly as soon as title work's done. So we can move quick. And I'm not saying all hard money lenders can, but most of them, the reason they're around is because they can close very, very quickly. And raising private capital it's tricky, right? And it's hard to raise tons and tons of private capital. And we've already raised lots of capital, and we're here to lend it out. So if you had to choose one or, finding deals is hard enough, right? So if you had to choose one or two jobs, finding deals or raising money, I would say you got to find deals, because who cares if you have money if you don't have any deals? Money will find deals. Find good deals. That's the most important part. As soon as you find deals, everything else kind of works its way out. And to be honest with you, using capital, if you can execute properly, using a hard money lender at 13, 14%, 3-4 points, it's very, very reasonable. And I'll tell you why. Because let's say you borrow $100,000 and you flip a house very, very quickly. You probably only need $10,000 or $15,000 into the mix because the hard money lender is putting up the majority of it. Yes, payments and some other stuff. But if you flip that house in 3, 4, 5 months, it's only going to cost you the interest rate's annualized, right? So it's only going to cost you like $10,000 for every $100,000 you borrow. So it's pretty affordable. All right, so we got another question that came in, and let's get this on the road. Josh Wyman, what's the most effective book you're reading, ready to help learn to manage people and grow your business? What's the most effective book
you've read?
You've read. Okay, sorry, you've read to help learn to manage people and grow your business. So mine's probably different than Chris's, but I'll tell you mine. The book that I just finished reading, that I can't remember the whole title. I'm looking it up right now, but it's something related to appreciation and 5 ways to appreciate your work staff. It's something related to that. Hold on, I'll bring it up right now. The 5 languages of appreciation. Got it right in there. So that was good because it doesn't necessarily talk about the actual managing or of employees or people in general, but it talks about different personality types and how you can appreciate them and train them and help them in a different way and show them each value. So for instance, it's not like, hey, do this. This is their type of personality type. This is the type of person that you need to be very caring and tentative from, and that's how you treat them. And the other person you have to be a little bit more direct on. So instead of kind of physically telling somebody how to manage you, it's more on a higher level of talking about appreciation and caring about people, employees, contractors, private investors, vendors, things like that.
Yeah. Just a couple of quick comments on that. It's very interesting how people, so people want to be appreciated in different ways. Some people on your staff are into money. Some are into recognition and praise. Some people are into freedom. Some people like the opposite. They like structure. So learning about your employees and their personality types and how you can best work with them has been hugely helpful. And it's an ongoing process. Like, it's not an easy thing. You assume that everyone's like you and wants what you want, but that's not the case. In addition to that, Josh Weidman, to give you another tip, not a book, but something that we got a lot of value from in that realm, is hiring a third-party consultant, a business coach, to come in and work with our staff, just like we've worked with business coaches in the past, to develop and grow as people how they want. It was a third party. It's not us directly with them. Like we're close and we're all friends and we work together, but at the same time, we're still the bosses. So having a third party perspective and somebody that they can openly communicate with, we found to be super, super helpful, and the staff really, really enjoyed it. So well worth the money for a good third party consultant.
Yeah, absolutely. Because keep in mind, if you have any employees, and I know Josh's questions were more just manage people in general, but if you have any employees, typically you didn't get into business to hire and manage employees as a full-time job. You got into business because you enjoy the trade that you're involved in, lending money, flipping real estate, buying rentals, being a dentist, whatever it is. It's not the most fun thing to manage people, but if you learn how to do it and you have kind of proper communication, proper respect, it makes it a lot easier. Cool. So back to the money topics. I guess we covered hard money lenders enough. If you have any questions related to hard money lenders, feel free to ask that question or comment below. Or if you want to click on this link in the comments section, you can jump on the broadcast just like Ian Horowitz did a few minutes ago, and be happy to answer your question on camera. So let's dive into banks if Chris wants to jump in on talk about banks for a little bit.
Yeah, we can definitely talk about some bank financing and different. When you say bank, it's like a big term, and there's different ways to break it down. But some of the different things are the big national banks that you all know of, like Bank of America, Wells Fargo, what have you. and your smaller local banks, like your credit unions and your, community type banks. And then also I would throw in there big national lenders who they might not be a bank per se, but they're using institutional money. Would you lump that into that bank category, Jay?
Yep, absolutely. Okay.
So Ian Horowitz, who was on a few minutes ago, he commented on a couple good things because he does own a bunch of rentals. He's always on top of what's going on in the financing world. And there are a lot of people who are using commercial type loans for their rental portfolio. So that may or may not apply to if it's a flip versus we own X amount of rentals and we're going to hold on to that. That's a different loan product. But that's definitely a good one to look into. It's an interesting time in the market just because there's so much liquidity. There's so much money around from all the different sources. So you have options. When the market's down, like you have few options. So the national type lenders can be a good way to go, especially for the rental side, not as much for the flips. And we like the smaller banks. We actually have a credit line with a local bank here for our own rental portfolio. And we found that to be a very, very good source, a good loan product, and a good relationship that we've built with them. So I would look into that too, your credit unions and your community banks. Not so much the large commercial banks like the Bank of Americas and Wells Fargo's of the world. For what we do in residential real estate investing, they don't seem to be a good source in general. So I'd probably skip that, focus on the smaller banks.
Yeah. And a key thing you were talking about earlier is it's easy, I know it might sound crazy, but it's kind of easy to get money right now. And banks want to lend money to people that don't necessarily need it, or they want to lend money in an environment where it's easier to get capital because they're competing with other banks to deploy it. So I would say now is the time to make sure your investment properties are stabilized. You have proper long-term debt in place if you need it. If you want to get lines of credit on your home as like a second or something, do it now. Rates are low. Try to whatever it is. But think about it. I would say try to get that money in place as quick as possible, even if it's a little bit more expensive, as long as it cash flows, just in case something changes in the future. Cool. So we talked about banks a little bit. We got a few more questions coming in. Let's see. And again, if you're just chiming in, we are talking money options for real estate deals. But if you have any question related to money, real estate investing, business, happy to answer any questions that you have. You can either comment below. There's that link that we just posted. You have to be on Google Chrome. No, I'm sorry. You do not have to be on Google Chrome. If you comment on this feed, we can answer your question. And if you actually want to be on the show, on the broadcast live next to myself and Chris, you have to be on Google Chrome and click on the link, and it works. Ian Horowitz, actually, I guess he's still back in Florida. He just had another comment that said this would be great for our meetup group to have a live Q&A for viewers from home. I agree. I think tech and software is changing the world. If you guys are on Facebook, like we all are, this is a BeLive broadcast from Facebook. It's a software that recently came out that we're utilizing. New features are coming out regularly. And tech is changing. Every time you log on to Facebook, they ask you for different updates. Things change. So make sure you're staying in place. So Torino has another question. He was on here a little bit earlier. He was asking, as a newly founded entity, and he's got about $15,000 in cash. What else is needed to start flipping properties using hard money? And he's in the DMV. And I asked him actually what area he was in, and he's in the DC, Maryland, Virginia area. But he said he was thinking about going to the Baltimore area. I'm guessing because the DC, Maryland, Virginia area is high priced. It's hard to get in on deals. It's very competitive there. So I would say, Torino, it's kind of like two questions. First off, going back to the area that you're in, I would say stick to an area that you're comfortable with and instead of trying to jump into different markets based on price points and things like that. If you're really comfortable in the DMV area, I would probably stick there. $15,000 in cash goes kind of, it's a good start, and it can go a long way. Us as a lender, if you're finding properties in some areas of some of the smaller properties and maybe Capitol Heights in Prince George's County, maybe some of the smaller properties in Landover, things like that you can acquire for under $100, with $15,000 cash, that's typically enough to get into a $100,000 price point using a hard money lender, us or another lender. Potentially maybe borrowing money from somebody else or some private investors to come up with the difference. If you're funding construction and you have lines with Home Depot and things like that, I mean, again, like we talked about, you want to make sure you have enough money from start to finish. You don't want to get yourself in a position where it's, hey, I only have $15,000 and I need $15,000 in the front end of the project, because if it goes over budget or if you go over the timeline, you could really turn this asset into a liability. But it is kind of enough to kind of start with and see if you can get a deal low enough where it limits your cash out of pocket. Chris, any other thoughts on that?
Yeah, I would also look into some other options in terms of putting some more cash together. Maybe it's hooking up with a partner, raising some private capital, what have you. $15,000 is going to be a little light for the price points around here, like Jason was saying, and you're going to give yourself more options in terms of what you can buy and how much construction is needed. You're just going to have more options if you have a bit more cash. So I would look into some other ways, such as a partner or a capital investor.
Agreed. Nadine, thanks for chiming in. Certainly appreciate it. Question is, if you get money in place like lines of credit, if the market changes, are the banks likely to reduce the line of credit or close the line of credit? And the answer is yes. You got to be careful. Unfortunately, banks right now in environment are fighting for your business, but that changes and they'll be happy to cut you as a client very, very quickly if, things change. So, it's one of those things. It depends on the type of line. It tapes on the line that you're getting. Make sure you read the fine print and exactly what it's set up, because let's say you get a $50,000 line of credit and it comes in to be a second mortgage on your house, and you're using that to invest in real estate. Great way to invest in real estate. The rate's cheap. It's affordable. You have the flexibility to do whatever you want with that money. So it's a great source. Right now in the environment, like when I bought my house years ago, I had a second line on it, and I was able to draw on it for a certain period of time, and after that, it permed out into a long-term loan. So it was like 5 years. I could pull money out, put money back in, whatever the case. It was a straight line of credit, and then it permed out. That's how a lot of these lines are. But just double check the fine print, because if they need money back and they need liquidity in their bank, they're going to do whatever they can to do so. But the good part is, investing in real estate in general, especially flips, they're short-term deals. So you use the 20 or 30 grand that you need out of it in order to flip the house, and then you pay it back when the money's done. So it's a good thing to think about. So I appreciate it, Nadine. Another question. I may have missed it, but what areas do you lend in? I'm in Dallas-Fort Worth. Certainly appreciate it. Our company, Hard Money Bankers, lends in Maryland, Virginia, D.C., New Jersey, and Philadelphia. We don't lend in Dallas-Fort Worth, Texas, but I will think if we have anybody that we know that's credible out in that area, and happily pass them along. Hard Money is a pretty localized business model. I know there's some national ones out there that want to lend everywhere, and our voice can be heard that we don't love that business model. We wouldn't
be the first time we said that.
Yeah, we like staying localized. I think it's hard to invest in a boots on the ground localized asset in a different market, so we're not going to lend in a different market. But thanks for your questions. And again, we got a few more minutes on this broadcast. We're going to talk about joint ventures in a second. But if you do have any questions, feel free to ask them anytime. If you comment on this, we can put them on the screen as long as that's a good question. And if you want to be on the broadcast next to Chris and myself, either between us or next to us on one side, feel free to click on this link right here and you can jump on. If you do want to be on the broadcast, you do have to use Google Chrome. Just FYI, until that's one thing we learned the hard way when we were setting up this broadcast. And again, every Tuesday at 11 a.m., we are going to be live doing questions and answers. So feel free to bring your questions. If you have any topics that you want us to discuss, we're happy to do so. So let's dive into joint ventures. You want to start on joint ventures, or you want me to dive in?
Yeah, maybe I'll start on that, then you can take it from there. But joint ventures, when we're talking about the different financing options, is typically going to be the most expensive one, even more so than hard money lenders or private capital. And the reason being that most joint ventures are a 50-50 deal. And they might even include like an interest rate return and then 50-50 to whoever's putting up the money. So they're typically going to be your most expensive. And there's definitely some things to be aware of when considering a joint venture. Like, it makes sense when you say, okay, if you put up the money, I'll do the deal. Like, I'll, find the property, do the work, everything else. And that can be a good setup. But you have to have both jobs, right? Like, you want the right kind of capital investor that you can work well with. And the capital investor is going to want to be very, very careful about the operator and how well they can execute and make sure this deal is going to get done. Because we've seen them go well, and we've seen them go very much not well as a lender and everything else. So my main comment in joint ventures is, one, know the cost, and two, be very careful about the partners you choose to team up with.
Yeah, those are good points. I mean, I do actually like joint ventures a lot, as long as I run, we have the upper hand on them and control the situation. And the reason I say that is, obviously, we have access to money. We've got some access to deals. We've been involved in deals a lot, but I like having the upper hand on it, because sometimes there's a deal that I just wouldn't want to do just because it's heavy lifting, right? So it's a deal and I don't want to mess with it. I'm even willing to put up the money on it, and it's a deal that we found, but I want someone else to just operate it for us. And then on other sides, maybe there's a deal that, I don't know, we put up it's someone else's deal and we put up the money, or maybe we just put up the deal and someone else puts up the money. But the thing with joint ventures is I do like kind of the upper hand and trying to control them when you have that ability to, just because it gives you a little bit more flexibility. And there are joint ventures that we've found the deal, put up the money, and sometimes even taken a smaller share just because someone else did the majority of the work. And I just don't want to deal with it. And it could have been a deal that, we would have just passed on anyway. So whatever it is, like Chris said, with joint ventures, just make sure your partner is the right partner, because that is so important. A partner will ruin a deal. And we've seen deals where there's a lot of profit margins to be made that every dollar got sucked up. And I've also seen deals that were so tight that people made a fortune on just because they were able to execute properly. So, we could talk about executing on a future broadcast, but executing cheese. Yeah. All right. So we got another question. I know, actually, it looks like we have another guest. We got Glenn from Corner Unit Media, local media. I'm sure he's got a good general business question. There he is, right there. Say hi, Glenn.
Hey, guys.
Welcome to the show.
Welcome. Glad to be here. This is pretty amazing, and part of what full disclosure, we've all known each other for a long time, and we do some business together. And you guys are what I would consider visionaries in some marketing plays. And I own a digital marketing company, so I think it makes a lot of sense to ask about that. So my background is in traditional media, so I understand the sort of importance of being out in front of an audience. But you guys are a lender, and you've been doing this for a decade now and done thousands of deals. When did you know that you needed to be on the forefront of marketing? Because you guys are very much, you're contributors to Entrepreneur Network, which is a big outlet. You're contributors to Inman, which is a big real estate focused publication, to business.com, all these different things. You wrote a best-selling book. When did you know you had to market and promote your business in a different way than just, hey, we buy houses, hey, we flip homes, hey, we lend money? When did you know that? How did you know that?
Yeah, Can I jump in on this one real quick, Jay?
Yeah, sure.
I got a couple things on that, and then I'm sure you have something to add as well. So I would divide that up into two, like you said, marketing, but then there's also content too. Marketing came first. And when we started, it was like social media was just getting going. It was early on in those days. It was about 2007. And we got into marketing and became marketing junkies because we had to. We had to make the phone ring. We had just started a company. Like, we didn't see that as being an option of like, maybe I will, maybe I won't get good at marketing. We had to make things happen, and we did. Learning web marketing mainly, definitely some offline stuff. Then later on came the content. And this is, I think, going to answer more of your question. Later on came the content, in that the marketing world was changing. Instead of just throwing ads at people or throwing emails at them or stuff in their face like, buy my product, it shifted to providing value to your audience and to your potential customers. And we started on that right away. And that's really what applies to anybody who's watching or listening to this right now, is that providing value to your target audience is super important. Hey, there's HIV, nice koozie. Providing value is always the right way to go. It doesn't matter if you're a real estate investor or a lender or a lawyer or whatever. So I think that's something that any small business person should really be paying attention to, not just doing their transactions, but providing value to your audience.
Yeah, I agree. And when we originally started, to be honest, a lot of it was a little bit lucky. We didn't exactly know what advertising or marketing to do. We were like, cool, let's just do it all. There wasn't nearly as many lenders in the space then as there are now. So I would say that luck had a big factor to it. It wasn't hope, it was luck. And
intuition, maybe, right?
Yeah, and we did some marketing campaigns that kind of just worked, and then we just doubled up, tripled up, and we just kept throwing more money at it because it clearly worked, and we didn't overthink it. Like, we knew we had to market, we knew we had to bring clients in the door. Originally, we thought we knew a lot more people in the space than we did. We're like, yeah, we know this person, we know this person, we know this mortgage broker, we know this realtor. They'll just feed us a few deals a month and we'll be good to go. But that did not happen at all. And our target clients kind of changed a little bit. I thought we would have kind of like a wholesale operation with mortgage brokers. We'll just go get in front of mortgage brokers. They'll just send us other deals and we do a bunch of bridge loans and it works out great. But long story short, we jumped in, we kind of just tried everything, and what worked, we continued to stick with and double up and triple up. And I mean, if you've heard us talk before, there's some marketing and advertising channels that we use that if we could spend 10 times more money on that, we would. If we could spend 10 times more money on certain things, we would continue to, because we know it works. We know exactly how much each email address is worth to us, and if we can get more and more of those email addresses, we could do it. I mean, we've somewhat saturated the market with 12,000 Facebook likes locally, a large email database, and we'd like to do more. But I think besides that, what Chris said, value is important. Doesn't matter what you are. Value. Stop trying to sell somebody an info product for a few bucks. Figure out what your high ticket item is. Figure out what you want to actually sell them on, whatever service is you're on, and give them as much value for free as you can until they eventually buy your product.
Yeah, I mean, for me, what you guys said, it's two very specific things. It's one, knowing you have to be out there in some level, and then two, understanding what out there means today. And it's not spam, buy. It's content, it's value, and then what kind of content you make to push that value. I mean, quite frankly, what you guys are doing right here is very tech forward, very cool, but you're also providing a neat, casual back and forth conversation to people that are in real estate. And, full disclosure, truth be told, I also happen to invest in some real estate. You guys know I have a few rental properties and dabble in some private lending and stuff like that. So, for me as a marketer, as a media person, owns a media company, I log in and I get tips of how to market for my clients that are accountants or doctors. I have nothing to do with real estate, but the basics of what you guys are doing of content and value is it's a really valuable lesson for anybody in the business. But to bring it back to real estate, no question about it. If you guys, you too, Jason and Chris, but also people that are lending from you or looking to find deals, if they're not marketing the right way to find those deals or find a joint venture or find a proper bank or find a proper lender or find a proper capital partner, they're going to be in a dark hole by themselves. If you put out there good content, valuable content, sky's the limit. So I appreciate it.
No, I agree. Thanks for your question. And we're going to wrap up in a second, but I'm going to leave everybody with one kind of quick marketing tip that, we've learned. And this is pretty simple, but we've learned, over the years, is so many people dive in and they market. They start doing business. They're doing great. They're in a good spot. And they forgot to keep marketing, so they're not marketing anymore because they think they have plenty of business, whatever that means. And then all of a sudden, all that hard work of marketing, all those deals start tickering away, and then you have a small pipeline again, and then you got to go start over and do market. So there's a much easier way. Just continue to market on a regular basis, no matter what. 10% of your day, 50% of your day, whatever it is, just a few minutes, a few bucks. Just keep marketing on a regular basis. It is so important. You got to continue to market so you constantly have a pipeline. And even when times are tough and our pipeline's on the smaller end, I know that our marketing machine is still running, and we're still constantly doing more and more of it. that even if you have some bad months here, some bad months there, it picks up because the marketing machine is running in the background, and it's running while we're sleeping. So it doesn't matter what business you run, what real estate company you're involved in, just market. So Chris, what'd you think about our first broadcast?
I thought it was fun. It was really cool. I like the technology. It's awesome how people can call in, and I definitely look forward to doing this every week, right? We're going to do it every Tuesday at 11. That's the plan.
We're going to do it every Tuesday at 11. Sometimes it's going to be both of us. Sometimes it's going to be one of us. Sometimes we're going to bring on some experts locally to answer people's questions. We will have a different link, I believe, every week, I think. Yeah, I'm pretty sure we have a new link every week, so check back. So what we'll do is a week in advance, we can set up the link, we can set up the feed, and then we're going to start sharp at 11 a.m. every week. We're going to be taking calls from the audience. It's going to be 30, 45 minutes. We're going to take the calls from the audience, business owners, people interested in money, finance, real estate, things like that. And if you want, you can click on these links below that are in the broadcast. You can actually get put into the lobby, and then like we did with Glenn, like we did with Ian, we can actually bring you up into the broadcast, and you can be live with us. If you want to answer your question, maybe get a little exposure in front of your friends or colleagues, that's always good as well. So certainly appreciate everyone who was with us over the last 40 minutes or so. We got one last question from Pete. Can you do this from the golf course? And the answer is absolutely, Pete. You can do this from the golf course as long as you have a mobile device or you're on a laptop remotely with Google Chrome. But other than that, we are good to go. We appreciate it, and see everybody soon. Thanks again.
See you next time.